Welcome back. This is Corporate Radar on CNBC TV 18. Let's shift focus now on TeamLease Services. The company's margins are on a declining trend. There was a sharp decline in profitability also for the company in Q1. They say that they continue to grow with their larger customers, and for Q2 they have a healthy pipeline. Ramani Dathi, the Chief Financial Officer at TeamLease Services, joins us now to discuss their business outlook. Ramani, thanks a lot for joining in. You have articulated the reasons for the fall in the margins earlier, right? You spoke to us about how there's been seasonality as well in some of these edtech companies. There's been the core employee annual hikes as well that you had to look into. But have the margins bottomed out? And just trying to understand whether this is a structural problem or more of a cyclical in nature.
Yeah. So it's mainly two reasons specific to Q1, as you have rightly mentioned. So we have our core employee annual hikes impact as well as seasonality in edtech. And the second reason is our higher margin contributing businesses, which are the IT staffing and degree apprenticeship. So both of them had heavy headwinds in the industry right now. And that has impacted our margin substantially. Having said that, from Q2 onwards, from this quarter, we are expecting a steady improvement in margins, both in percentage terms as well as in absolute profits. Mainly driven by the growth in staffing business, because we are seeing demand across sectors, be it BFSI, telecom, retail, consumer. Across all segments, we are seeing good growth. As of now, the only segment where hiring is not happening is in IT. Again, within IT, the GCCs fortunately have started hiring, and we are hoping that that trend will continue for next couple of quarters as well.
Okay, so when you talk about, that trend continuing, can you tell us when do you think the margins can get back to that 2% plus mark? I mean, any kind of exit margins that you're looking at by the end of FY24?
To be very honest, without recovery of IT, I don't think we can get back to the 2% margins at the company level. And for the time being, we are focusing mainly on the absolute profit expansion. Like Q2, we are expecting at least a double-digit kind of EBITDA growth on a sequential basis, and Q3 being seasonally high for staffing business with the festives and all of that. So we are hoping Q3 will be our highest contribution, both in terms of headcount as well as margin. But this year, 2% we may not be able to get to.
Can the big sort of uptick that we're seeing, and there's a fair bit of excitement, Ramani, now around GCCs, right? And the large potential that they offer, can they, in some ways, over a period of time, counter, the way that IT services has for you as a business? Can that be a very large opportunity? I mean, how much is that as a percentage of your business?
So 2 years back, our GCC contribution in our specialized staffing headcount used to be 30%. And that number has now substantially grown to 50%. So out of the 8,000 headcount we have in IT, 4,000 is coming from GCCs and captives, which is a very healthy growth. And we believe that in the coming years, maybe it may take 3 to 5 years, there can be an equal contribution from GCC, similar to IT services in terms of overall employment in IT.
In IT, you said that, until IT doesn't recover, you won't be able to get back to the 2% mark. Just trying to understand this whole IT slowdown, do you think it's a prolonged period of slowdown? I mean, how long do you think it could last, A? And I'm asking because, the companies are winning a lot of large deals, utilization levels have gone up. So do you think that it's just a matter of time before the IT hiring picks up as well?
Very difficult to comment when the hiring will pick up, because as of now, at least within IT services, we haven't seen any kind of green shoots. As I said, GCCs are hiring, and next 2-3 quarters as well, we have visibility of good amount of hiring there. But as of now, the volumes coming from GCCs are still small. So only with IT services demand recovery, we can see a substantial jump in the overall hiring numbers. And how long this can continue, again, there is no visibility. It's already been more than 4 or 5 quarters now. And can it be extended? Maybe yes or maybe no.
So what is the overall headcount that you anticipate in Q3 and Q4?
So in IT, there won't be, because typically Q3 is a complete off-season for IT hiring. Q4 also, it would be more or less kind of a very nominal growth. But general staffing, we are expecting very good growth in Q3 because we have the festive season and across all segments, we do the maximum hiring in Q3. Q4, we should do more or less similar to what we have done in Q4 of last year.
So just leave us, Ramani, with how you can sort of look out for the full year, considering all the trends that you described, with the IT still being subdued, but the general staffing business picking up, as you're saying, the market's very buoyant. Overall, for full year FY24, what's the revenue visibility you have now?
Yeah. So we should be doing at least 25% overall revenue growth, even without IT being very strong in terms of both on headcount growth and revenue growth. But general staffing will drive the top line growth for us. And in terms of overall headcount growth as well, we are expecting close to 20%, mainly contributed by our staffing business. In terms of margin, as I said, it's very difficult to comment on margin expansion without the pickup in IT. So we are focusing on profit expansion. So sequentially, we are expecting at least a 5 to 10% growth quarter on quarter.
Okay, so you're just coming back to one number, right? I don't know if you can give me that number, but this PAPM, which is the per associate per month, kind of like your realizations. In Q1, it was 680, and you said that in the conference call that you're growing some of your large customers, but I didn't understand what the impact on that on your average realizations would be. From this 680 rupees number, do you think you can extend it for the rest of the year?
Yeah. Yes. So the PAPM with large clients, our negotiation power is relatively weak. With more growth coming from large customers, they'll continue be a pressure on PAPM. So that's why we are focusing on a well-diversified portfolio of large, medium, small customers and across all sectors and industries. In addition to that, we are also upselling value-added services to our customers, which will give us a higher realization on our overall PAPM. So with that, we are expecting that this year, we should get back to at least a 700 PAPM by end of the year.
All right, Ramani, got that. Thank you very much. Good chatting with you today and good to get perspective. So IT is basically where the trouble seems to be. Let's see if that improves over the course of the year.